SwamiGuru, with all the advice that you had given on money and how to manage it, could we ask, how did you learn how to manage your money over time?
The way I learned about money started with a foundation from my mother. Being a single mother, every dollar for her was valuable, and it was an everyday effort to stretch every dollar. So that when I started to grow up and I started to earn, I had the same mind that every dollar is valuable. So over time, that was the foundation for me to save as much as possible, but also enjoy when I could, rather than putting enjoyment or having an enjoyable lifestyle as the priority. Saving and stretching was the priority. Then once I reached a certain age, I invested in my first house. It was very, very cheap compared to today, but at that point it was very important. And I started with the same strategy of renting first, understanding the responsibilities of having a home, and then investing in a home. And then that actually made me to invest in myself by getting more skills and also going for work or jobs that were more important for me. And I've been in the investment banking industry or capital market industry throughout my whole life. So investment in shares, I've seen a lot of people go in for the wrong reason and suffer. And I also have seen a lot of people who do it as career and are successful as well. And people who have gone in with the right understanding of the market and are very, very successful too. So those tips come from the lifelong learning experience of 32 years of seeing people in that industry, how they've grown and how they've not grown and how they have failed as well. So when you look at it, when my lifestyle changed and everything, and property prices were more expensive, then investment strategy has to change. One of the most important part is having capital before you invest, rather than investing to find capital. So you have to grow your capital by saving first. Once you've grown your capital, then you invest. When you invest, make sure that you're investing in an appreciating product rather than a depreciating product. If you're going to invest in a depreciating product like cars and everything else, then make sure that your capital inclusion into that investment is higher, so that you don't lose out in your interest payment and you're paying for much more than what you are bargained for.
SwamiGuru, let's turn to credit cards and your advice on how should you guide youngsters to use this plastic money, as many think it's a form of spending money when it really doesn't exist.
Well, use of credit card is a very good example of not living within your lifestyle. There are two kinds of people who use credit card and also debit cards. I think debit cards are very clear. You spend what you have. When it comes to credit card, there are people who use credit card for spending for a mode of convenience, because they don't want to carry cash around, so they use a credit card to pay. Some people are even more smarter. They pay via credit card is because they want to collect the reward points and to buy more things. So they are very, very focused in how much they can earn or how much they can enjoy more. That means they are stretching the dollar value. Remember, when you understand how much each value of each dollar is, you don't mind spending with credit card, because your bonus points and everything collectively will allow you to buy more things, even not today, but eventually. So you know that your dollar is stretched. Credit card companies knows about it. So that's why they give you a lot of cash back, like 3%, 5% on lifestyle products, your petrol, your groceries and everything, because they know this is regular spending. So the more you use your credit card, the more that they are going to do. Then you may ask, where do they make money? Because when you pay, there are people, out of the 100 people who have a credit card, 80 people are going to go on credit. Only 20 people will end up paying it full in every month. So those people who paid for convenience will not have an outstanding balance at the end of every month or at the end of the payment due date. They are doing it for the sake of convenience and also investment into future money, where your bonus points and everything becomes stretchable dollar to buy new products. For those people who are buying it for credit, now you are spending money that you don't own yet. When you spend money that you don't own yet, you don't realize how much or when to stop, because every dollar is free. You have no intention to pay. But actually, every spend, imagine if you go to a shop and you are going to buy a product that is 10 ringgit worth. If you think that is fair value to pay, would you pay 11 ringgit 80 cents for the same product? You definitely will not pay, simply because it is so much more expensive. Spending in credit card is the same way. When you spend tomorrow's money today, you are buying the same product for 11 ringgit 80 cents. Why 11 ringgit 80 cents? Because of the 18%. That is the flat annual rate for credit card purchases, right? However, if you pay minimum amount, that is going to be compounded. You could end up paying 15 ringgit for the product that you could have bought with 10 ringgit. So you have lost 5 ringgit. Where's the saving mentality? Now you have a double whammy situation where now you are buying more expensive product, your lifestyle is more expensive now, and you're spending tomorrow's money or money that you have not owned. This is why it becomes a disaster. Emergency spending is fine, because people who use it for emergency will try to pay it off within 1 or 2 months because they have a shortage or they just want to do a rollover. For that, it's also a convenient. So understand what you're buying. Your money is not being stretched. The value of your money is shrinking, or worse still, the money that you don't yet own when you spend on credit card. So be careful about how you use your credit card.
And last question, what are the financial priorities of today's generation compared to your generation and that of your parents during their era?
If you look at today's financial priorities, there are different kind of people. Many people have chosen lifestyle, right? So when you talk about lifestyle, car, houses, or look good kind of thing, they don't think about the value of the assets that they are investing in. When in my time, we had different kind of priorities. We had priorities of investment in ourselves, a good education, and from a good education go into a stable income, then get into an asset investment for the sake of making sure that we have a stable and firm lifestyle, not that we have a flamboyant or nice lifestyle. Nothing wrong with that, it's just that priorities are different. So our priorities were investments and to help it grow so that we will have better life at our older age. So we will travel less, we will spend less, we will do things that is needful. However, today it's a lifestyle of enjoying what you have. So you enjoy, which is good, because they have, to a lot of youngsters, their mindset is, I can earn anything, because they believe in themselves, they believe in their skills, they believe in their value, that they are gung-ho to go out there and get whatever they want in life, which is a very, very, very good attitude. But if they take a portion of what they're spending and also save, now with their attitude to do better, they have the capital to also enable that attitude to do better. They don't have to be dependent on anything. So combine, I like your lifestyle, I like your thinking, but combine that with a level of saving, and then spend with authority, or spend with the right capital in your mind, rather than thinking that you have to borrow and pay for the future. So right mindset, convert it to a saving mindset, capitalize your finance, and then go all the way.
SwamiGuru, what about people who have been successful in investing in shares?
So when we look at shares as an investment, investments are for long term. Definitely people who actually make money in the share market or stocks or investments in a very short term. There is a difference between them and the regular people who have daily jobs or other jobs. because investment in shares are more of a passive income where it grows better than your fixed deposits. However, these people are career investors. When we talk about career investors, for them, this is where their mind is totally focused, and it's a daily job. It's a daily or minute job. Every minute they are looking at the market because they know when the shares will move. They do a lot of studying, where they study the technical charts, they study the company, they follow through a lot, and they look at the movement of share prices, they know the trend, they know the behavior and everything. So it comes with an understanding of how it works. Remember, I spoke to you all earlier about having the understanding of how finance works, right? So these are people who have chosen investment as a career. They are there full time. It's not a passive income. So these are the people who watch the market, understand the market, and know how to buy and sell and everything. And they are very, very successful. There are many people who have made millions out of the market, but they don't do it for the sake of making a quick money. They don't have a problem where their other businesses or anything has a shortage of income, and they have to now go into the market to do a quick investment or quick go in and out of the market and come out to solve a problem. They don't go with that mindset. Anyone who goes into the mindset with that kind of a need will definitely lose money, because they are emotionally tied up to the loss that they are trying to cover from something else, and they are going here not without understanding the mechanics of how it works, but just going into hoping to make money without understanding. So just like scams, they will get involved in I want to get it happen. I want it to happen. I want to. So their investment will not be sound investment. Their purchases of stocks will be without fundamentals, right? So they don't know what they're buying. All they want and they are buying is profitability and quick profitability. They are not buying shares. They are not buying stocks or whatever. They are just looking for quick buck. So this is different from those investors who have made it as their career. So I've seen a lot of teachers, bankers who after retirement have become dealers or remisers who have made it their career to continue. So they sit down every time the market is open, whether it's Malaysian or overseas market, and they are following the market, the trends and everything. So there are some people who do it on their own. There are some people who do it and also earn a commission by getting customers for it. So these are different from those people who are going into the market for investment purposes, right? It's not for quick buck, passive income.
And what would your advice be on owning health insurance or endowment policies?
Well, when we talk about health insurance, right, many people don't realize that health insurance is not insurance against your health. It is an insurance against the cost of managing the hospital expenses due to a health problem, right? So it is financial investment. Even though you're getting a medical card or health insurance, it is a financial protection investment, not a health protection investment. Your health protection investment comes from maintaining a good lifestyle, right? But you don't know what's going to happen. You don't know how to do everything the right way in terms of managing your lifestyle. We may be somebody who loves good food and enjoy life, but one fine day we may have something that's wrong with us, and then when we go to the hospital for a regular checkup, then we will have a problem. So I'm not saying that maintaining a healthy lifestyle will definitely get you into a hospital bed. No, many people don't, but everything in life is to do with moderation. However, healthcare expenses are rising, right? To mitigate that, especially when you are older, your revenue stream is going to get lesser unless you have stable income throughout your life, right? And your savings, right? So you may want to enjoy life, go spend holidaying and everything, but you don't want to end up in a hospital, and you definitely don't want to be ending up worrying about the expenses. Now what you do? Health insurance is to protect you from that unforeseen circumstances of impact to your financials. That's what health insurance is all about. Now, this is unanticipated savings. That's why it's called as unanticipated expense. So that's why it's called insurance. Now, when you talk about endowment policy, it's an expected expense. So when you are starting a family, you have your kid who's going to go to college in 17 years old, or maybe you want to buy a car when your kid wants to be 30. So you have different endowment policies that will mature when your kid reaches at that point. So you know that you're going to have a spiked financial expense, but you start saving now. So the regular savings will not give you enough growth for that quantum. So you need to know how much you save now, and it'll give you that stable growth. And so you will never gamble with that money, right? And it's not insurance. Of course it's insurance, but it's an endowment policy. So this is why you need this kind of investment. One is for unanticipated spike in your financial expense. The other one is anticipated and planned financial expense.
Very well said, SwamiGuru. When it comes to big ticket items like owning their cars or investing in their own property or even buying shares, would there be appropriate time and occasion to guide and counsel them on how to manage these purchases?
When we want to own big items like car, house and investments, right? We know we must first understand the financial landscape of the world now. When you own a car, what are you going to do? You're going to take a certain portion of your daily income and put it into to pay for your installments, correct? How often would you use the car? Today the world is so different that if you need a transportation, you can get the transportation. So if you talk about the number of times that you travel versus the value of the money that you have, so take the free ride-hailing services. So if I am going to travel 2,000 kilometers in my whole life, right? I mean in a month, yes. So I'm going to travel up and down. So I'm going to be chauffeured around, I go for the ride-hailing. How much could I spend? And then if I'm going to go outstation, can I rent a car? Yes. Now, take that and talk about how much of money that you're spending to pay installment for a car. Now you may see there is a gap, how much you're actually spending by leasing for that transportation versus how much you're investing. Now when you lease, it's burnt. When you invest, a lot of people don't realize in a car, it's also burnt because you're spending more and you're going to get less. It's not an investment because the asset is going to depreciate. However, assuming you spend 1,000 ringgit on your transportation versus you're spending 2,000 ringgit on your car on a monthly basis, save the 1,000 ringgit that you're going to do. Put it into a savings. In your mind, set that you are spending 2,000 ringgit for your installment, but you spend lesser by getting ride-hailing. Now the extra 1,000, save it. I'm not saying you don't own your car, right? After 2 years, you have 48,000. So what happens? You can buy a car of your dreams, a better one, with lower interest rate and higher investment. So you now have saved enough to go and buy that, paying out the excess interest and mitigating the depreciation in a better way. You take a shorter loan, you can understand it, because now when you do, you are still going to save 2,000 ringgit or pay 2,000 ringgit installment, but for a higher down payment. So you actually pay lesser interest over time and you pay it over a lesser number of years, and you still get a newer car in 2 years' time of your dream car. So what I'm saying is, don't jump into an asset buying. Practice about your payment cycles for that asset buying before you go into that asset buying. That means align your mindset that that's my spending, but make a saving and then go into the spending. Same thing for the house. Go into renting, but spend or save. That means when I say spend, that means it's pay and spend. That's your pay and save. That's your spending value for your asset. If you buy a house, you're going to pay 2,000, 3,000 ringgit in installment for 30 over years. When you buy a house for 30 over years, if you buy a house that is 600,000, you're going to pay back the bank 1.2 million. It's always almost double. Now, however, when you go and rent rent it for 1,000 ringgit or 1,005, whatever difference, the balance, save it. Keep saving it for 3 to 5 years. I did that. And I owned a house that was, 6 times more expensive than the house that I would have bought 6 years earlier. And I could afford it because of this mechanism. So when you save this, your mindset is accustomed to spending 2,000 for a house loan, but you're only spending 1,000 ringgit. What people don't realize is house loan is not the only expense of owning a house. There is the assessment, the quit rent, the electricity, water bill, maintenance that you are not accustomed to. So you get it accustomed to when you are renting, right? And you are saving. Now you have a larger capital 3 to 5 years time. Then you buy. Wait for the market to be ready for you, right? When you buy, now this is an investment because it's going to appreciate. So buy when it's low, when it's the buyer's market. Now you're going to put in more capital, and now you know how to live in a house, how to make it to your liking. Many people jump into house buying, then they do renovation, then they do this. Then when they start living in it, they don't feel comfortable. But now when you have rented, you have lived on your own, you feel comfortable and everything, you actually know what you want. So in the first example and second example, you're buying something when you're ready to buy, and you're experiencing the owning of it by renting, right? And you're only going to buy it with enough capital, which maintained within your lifestyle for a product that you have a bigger value compared if you bought it earlier, right? So this gives you where you are training yourself into your lifestyle that you like and you can sustain it. That's very important. In the same manner with shares, a lot of people jump into shares because they have extra money and they invest into it because they want to make extra money in a short term. There is no such thing as short-term investments. Investments are always for a long term, right? It has to grow. While your money grows, you need to allow your investment to grow. Of course, you choose the right ones. So if you see an investment that's very often too good to be true, when it's too good to be true, then it's not good at all. Because there's no investment that will give you 30% return in a month, in a year. There are, but it's too good to be true. There are promotions. And this is why a lot of people lose money to scams. Because they are not in need of investment. They are in need of extra cash in a short term. That's a wrong mindset if you're looking for investment.
As an elder, a wellness coach and a father, how did you lay this foundation in your children?
When we want to talk about managing finances in our life, first thing, there are 3 elements when we talk about managing finances itself, why we do it. When we talk about the majority of population, it's because of their fear of not having enough money. So they need to manage these finances in order to negate that fear or manage the risk of not having money. So what do? They make sure that the money is stretched. They make sure that they have enough savings. They make sure that they have enough money to spend. The other foundation of why people want to manage finances is because they want to have a comfortable life. Or they know that the money can grow and they save more. And these are 2 different aspects. One is out of fear, the other one is knowing that it will grow. So when you talk about these 2, the most important element part of it is the third aspect. Understanding the value of money. That means it's not about the quantum of money that you have, but each money that you have has a different value to its quantum. What does that mean? That means I can take a ringgit or a dollar and stretch it out to buy more things if I understand its value. If I regard a dollar as something that is of a small change, then it will be valueless to me. So it's not enough always. So this is where people don't understand. When you want to manage finances, the foundation before you even start that process is to understand whether you understand the value of money. So what is the value of $1 in your life? What is the value of $5 in your life? What is the value of 100,000 in your life? Now everybody has different economies of scale because they have created a different kind of lifestyle for them. Now we yearn for lifestyle. So when we yearn for certain lifestyle, we don't realize the lifestyle that we are living. So when we don't realize the lifestyle that we are living now, what happens is that maintenance of that lifestyle is where it creates a fear that we won't have enough. But that lifestyle is something that we created for ourselves, right? And a person who's earning 5,000 a month will have a lifestyle that fits a 5,000 lifestyle. Now when he or she has that 5,000 lifestyle, what they do is they do better. They will live better. So they create a shortage of money for that lifestyle. Now what they do, they go find more money. So they're going to look for a 10,000 ringgit job. Once they get into the 10,000 ringgit job, they go and adopt a 10,000 or 12,000 ringgit lifestyle. Now when you adopt this lifestyle, there's no room for savings. There's no room for growing money. It's always maintenance of this. Now, when your 10,000 income level with a 12,000 lifestyle is being managed, you are now in a problematic situation where you have a fear that this 10,000 cannot be disrupted. So if it's a stable income or if it's from a business, you're now going to take your fear of maintenance of lifestyle and put it into your work or your business. I need to do this, I need to do this, I need to do this. The passion to do whatever you're doing that's giving you the money is going to lose. You're going to lose that passion. You're only going to look at the fear of protecting it. When you have the fear of protecting that source of income, what will happen is you will destroy it. You will automatically destroy the source of income because it has gone from an appreciation, from a passionate work kind of environment to a fearful that you cannot lose it. You will be stressed out and everything. And we blame money for it. It's not. We should blame ourselves for it because we did not manage finances. Managing finances starts with managing lifestyle. I'm not asking you to be stingy. I'm asking you to have a lifestyle that you can enjoy within your means. It's not living a lifestyle within your means, but you don't enjoy. Enjoy within your means. Because remember, when you were earning 5,000, you lived a life of 6,000, right? And it was a shortage. Now when you're earning 10,000, you are living a life of 12,000, but you are comfortable with 6,000. So you have the opportunity of a space of savings and growing the 4,000, but you choose not to. The world doesn't need to know how much you earn. It is you who are telling the world, this is the lifestyle of how much I earn. But you may not be happy with it. You may not have enough money because you're trying to prove to the world that this is the lifestyle of who you are. But that's not who you are actually, if you're not happy. Right? So you are creating this disruption. So this fear needs to remove. And the foundation is how you are seeing the value of money to you. Right? A different person, a billionaire, may not see the value of $1. But remember, he saw the value of $1. That's what made him a billionaire. Right? So you must understand, it starts with the foundation of value of money. So when you remove this fear and you understand the value of money, now you're set for growth because you know that every dollar can grow. You know that I don't have to invest in 10,000 ringgit to see a maximum growth because people who don't value that dollar will not be happy with $1 growth. But every dollar growth is a valued growth. So it doesn't matter whether you're saving 1 cent, whether you're saving $100,000, it is important that you're saving and it is growing in proportionate. Be happy with that growth. When you're happy with the growth, when you accept that growth, your mindset automatically changes to put in more to grow. So when you go and spend, this is going to shift the way you think. When you want to spend something, I want to buy a $10,000 watch, you will automatically come back and say, but how often do I wear it? Why do I need it? Right? So my mind will go, even the 10,000 is going to be there for the watch, I now can shift that because I know I don't need it except to just project something. I will go and invest it. I will go and save it, because investment and saving is my mindset now to grow, not of a fear that I don't have, right? And that automatically creates a cycle of you, every dollar that you see, you'll put it in your piggy bank, right, to grow.
Is there any particular age that youngsters should begin to know the value of money and start to handle it appropriately?
There is no particular age. I think value of money and growth is defined by when parents start giving money to their children and why they give it. Most parents or most generation, every generation, it is an obligation for them, or it's a requirement for them to make the next generation live a better life. But they are doing it out of the fear of what they have experienced. They don't want the next generation to experience. So they give them more money, because you or we would have lived a life that is shortage of that money. And what we do is we will go and give more money to our children so that they can have that income or that money to go and spend. So they don't go through the experience of not having enough money. They take for granted for all the money that they have, and they may not spend it the way that we do, right? Why? Because we had a shortage of money, we had a requirement of money, we had a need of money. So that extra money went for the need. Now we don't want our children to have that shortage of money or suffering due to money, but we just pump in money to them. Remember, you're giving them money to avoid your need of the past. They don't see there is a need. They don't see the shortage. For them, it's a surplus of money. Now you have created a disaster for your children by making them having surplus money without understanding the value. So for them, money will always be there and it'll come. I don't have to be worried. It's good that they don't have to be worried, but they're not going to grow it. What happens when you're not there? So one of the things that I did with my kids was gave them education, gave them a place to live, gave them food to eat. And then when they went to college, they had the same thing. In college, they have different circle of friends. So they had their own entertainment, they had their own needs to spend and everything. For all those things where it was a need, they shouldn't be dependent from me for that, to fulfill their need. They were asked to go and work for their money. So they enjoyed something, but they understood that they were getting money out of their hard work, and they were spending it on things that they love to do, right? Which is an extracurricular activities, happy. But they understood the value of money because they earned it. It didn't come to them for free. So that's the foundation that I put in. So if you want to give the right foundation about understanding the value of money, teach your children the value of money before you give it to them, rather than expecting them to understand the value after you give to them.